So you can keep an AMM open indefinitely. There is no time limit on the AMM. It is truly a perpetual product. And this is actually one of the advantages of the AMM is that for someone who's a passive investor, if they want to just set it up and just keep it on open forever, they can. And you also have instant liquidity. So you can also redeem or take it out, take your funds out, take your positions off at any time. So the risk with the AMM is really twofold. You are taking directional positions in crypto markets. So let's say you're running a buy-only AMM, you are going to be purchasing futures contracts, you're going to be purchasing the cryptocurrencies themselves. As the market moves lower, you'll get more and more of these futures contracts, and then as the market goes higher, you'll be selling out of these futures contracts. So the risk is really, again, following with that buy-only analogy, is that the market goes down quite a bit and you just get stuck with a long position, long the cryptocurrency that you've selected in the AMM. And basically you're just, if you're leveraged, you're paying the interest on that, or if you're unleveraged, you're just holding that position. And you're not, if it goes out of your range, let's say your range is 3,000 to 4,000 on ETH, and it goes below 3,000, you stop earning the yield from the volatility of Ethereum. So that's really the risk on the AMM, and that's why it's important to pick price ranges and currency pairs and trading pairs that are that you feel comfortable with. So the difference between leveraged and unleveraged is really to do with liquidation price and funding rates. So when you're leveraged, you have the ability to trade more than the capital in your account. So let's say you're doing a buy-only AMM, you're using $1,000 worth of Ethereum. You can now buy $2,000 or $3,000 worth of Ethereum using that $1,000. You also have cross-collateral. So let's say you're putting in ETH or BTC and you want to be buying more of these things. Well, in an unleveraged world, you have to put in USDC or FlexUSD to buy something. But really in a leveraged world, you have to have, you can pick whatever collateral you want. So that's one of the benefits of leverage. The downside is really liquidation risk. So if you're buying way more than you have in your account and the market goes down, you have the risk that you'll lose your initial collateral as well because you get liquidated. And you also pay funding rates. And CoinFLEX's funding rates are, typically speaking, cheaper than the rest of the futures markets out there. This is because of FlexUSD providing funding into the market. But when you're unleveraged, you avoid both of these risks. So you avoid liquidation risk, you have no liquidation risk, and you avoid ever paying funding. The benefits of cross-collateral are really that you can use one asset to buy that same asset or even trade a different asset. So for example, you could use ETH to market make Bitcoin. You could even use FlexCoin to market make anything. And what this means is really on Uniswap and most DeFi platforms, in order to run an AMM that's in the USDC versus Ethereum pair, you need some USDC. And you might need to be 50% USDC. But for many of us in crypto, we denominate our wealth in crypto, we think in crypto, we live and breathe crypto. The idea of selling some of your assets in order to provide a dual-sided pool of liquidity is very unattractive. The idea of providing liquidity in a way where you're in crypto 100% the whole time is very attractive. And so that's what CoinFLEX's AMM allows you to do, is be 1x leveraged or low leveraged and use Ethereum or some sort of crypto asset to provide liquidity in that crypto asset market.